Right, ladies and gentlemen, I'm going to assume at this point that we have a sufficient caucus, and I would like to get matters started. Welcome back to the second session of our conference from the Government Employees Pension Fund, and leading on from what the Finance Minister spoke about a little earlier, a call for more bilateralism and also some very strong and important comments on the importance of climate change when it comes to investment protocol and strategy. That segues nicely into our next panel discussion, which is entitled Navigating an Uncertain Environment. As far as South Africans are concerned, I would contend that navigating an uncertain environment at the moment means, do we move from stage 2 to stage 4? Is my inverter charged? And have I stored enough hot water until tea time? But I'm assuming that the conversation is a lot deeper than that. It is my great pleasure, ladies and gentlemen, therefore, to introduce you to Philip Dongsu-Hong, Senior Financial Officer, Reserve Advisory and Management Practice at the World Bank Treasury. Philip will lead the panel discussion, and that will take us through until the lunch break. Welcome back, everybody, as we start section 2 of the conference.
Thank you so much, Jeremy, for your kind introduction. I believe you all had a very nice coffee or tea break. Again, it's great to be back in Cape Town in 3 years to meet with friends, colleagues, and partners. I would like to thank you, the GEPF, for giving us an opportunity to co-organize this fantastic Pension Thought Leadership Conference again this year. It is my honor and pleasure to chair the important discussion session on navigating an uncertain environment. As many speakers and panelists in the previous sessions laid out, indeed we live in such unprecedented times. The past 2.5 years have been extraordinarily difficult for policymakers and public asset managers. Many of the challenges in existence before the pandemic, such as feeble economic growth, income disparity within and across countries, high levels of public and private debts, climate change and its implications on the global economy, have been amplified by the economic fallout of the pandemic and another layer of uncertainty, including prevalent high inflation, the war in Ukraine, and more hawkish monetary policy stance by major central banks, including the Federal Reserve Board, with rising interest rates. In particular, these uncertainties affect significantly the long-term sustainability of public pension schemes across the globe. And the question is how public pension managers can navigate this uncertain environment. Therefore, in this panel discussion session, we'd like to tackle the following issues. Number one, what are the key elements of governance and pension fund management in navigating uncertain times? Number two, how do pension funds align their risk tolerance, investment horizon, and eligible asset classes in the event of lingering inflation and geopolitical risk? Number three, how does the uncertain environment impact the framework of asset liability management and strategic asset allocation? Number four, what are the effective communication strategies for stakeholders and pension beneficiaries in addressing challenges? To respond to these questions, we have organized a fantastic lineup of panel speakers. Allow me to introduce them briefly. To my left is Sifiso Sibia, who is head of investment in the GEPF, which you well know, more than 2 trillion South African land asset under management. His near 2 decades of experience in professional expertise include financial services, investment in multi-asset classes, financial risk management, and employee benefits. To his left, we have Gabriel Peter, who's leading the team responsible for the asset allocation and ESG integration strategy for the World Bank Pension Fund, with more than $30 billion asset under management. Gabriel also provide advisory services on governance, investment policy, and asset allocation for developing country pension fund. To his left, we have Shafiq Abrams, who is Chief Executive and Principal Officer of the ESCOM Pension and Provident Fund. As you well know, the EPPF is a defined benefit fund serving approximately 80,000 members, and its asset under management is approximately 170 billion South African rand. To Shafiq's left, we have Ono Steenbeek, who is Managing Director of Strategic Portfolio Advice at APG Asset Management, which manages 650 billion euros of Dutch pension fund assets. Ono also holds a chair in pension fund risk management at Erasmus University in Rotterdam. As a ground rule, we'll start with two presentations. First, Sifiso's and Gabriel's, and then we'll make a pause for a couple of questions, and then we'll continue with the other presentation, like Shafiq's and Ono's. Each panel speaker is expected to deliver their presentation for about 10 minutes or so. And then we'll have Q&A for about 20 minutes and open the floor for the remaining time for the audience. Without further ado, I would like to invite our first speaker, Sifiso Sibiya, who's going to share his view on investment risk governance, governance challenges, and solutions. Sifiso, floor is yours.
Whoops. Thank you, Philip, for the introduction. And good morning, everyone. So basically, I'll be presenting on what I'd call the thoughts and reflections of an asset allocator, but in particular with regard to risk governance in uncertain times. So the three items of discussion would be investment risk governance, basically broadly outlining what we're talking about. I'll then talk about some of the governance challenges with regard to investment risk, and then some possible solutions. Firstly, in terms of investment risk governance. So it can be defined as the determination of risk tolerance, the elements of optimal risk exposure, and the oversight framework. So ultimately, it is the responsibility of boards of trustees. But however, and in many cases, this is delegated to the investment committee, who, amongst other things, is tasked to determine the investment policy, the strategy and procedures of the investment policy and principles, and ensuring that the strategy is executed via procedures which are a bit more day-to-day. Another task that the investment committee is tasked with is the appointment of service providers, including investment managers and investment consultants. Then broadly as well is the monitoring of investment performance and policy compliance thereof. So key to executing investment risk governance, you have the idea and concept of risk budgeting. Now, risk budgeting is the process of allocating resources to components of the investment process by considering their characteristics and their contribution to total risk tolerance and or risk appetite. So broadly, you can decompose this into two aspects. So the first is policy risk, also defined as planning or strategic risk, which basically is aimed at determining the investment objectives, the investment policy, and the strategic asset allocation, which is the asset allocation which allows you as a long-term investor to meet your long-term investment objectives. Then the second aspect of risk budgeting refers to execution risk. So this refers to the selection of securities, rebalancing and performance of the portfolio, and risk monitoring thereof. Now, in terms of executing this and maybe defining it more concretely, this idea of risk budgeting, we can delineate it further into, I'd say, two aspects, right? So the first is, you term it surplus risk, and secondly, active risk, right? So surplus risk is a deviation off your strategic asset allocation to the liability profile, right? So you can measure, this is basically a measure of policy risk, which I mentioned earlier on. Now, the second component is active risk, which is basically the deviation of your actual portfolio to the strategic asset allocation. So I'll speak to the challenges that this brings thereof. So the first component which is surplus risk, is I'd say, is the asset allocator's responsibility. And our responsibility generally is to minimize surplus risk. Now, this is done primarily through having a liability cognizant investment strategy. And a key component of this is having regular asset liability matching exercises and ensuring that the investment strategy follows that. Execution is generally delegated to your investment managers and or investment consultants. And our duty as allocators is to oversee the management of this risk. And I'll speak to the challenges of that particular aspect within an environment which is uncertain. So, where are the challenges? So, investment committees meet at regular intervals, depending on the nature and structure of a pension fund. It could be quarterly or monthly, but significant events may and do occur in the interim. So enlisted markets are very dynamic, and significant events are largely unpredictable. Within unlisted markets, things are less dynamic, but there's a range of complexities and time sensitivities of transactions that occur there. Now, the second challenge that you have is, I would say, an overlapping of responsibility in the management of policy and execution risk. So I mentioned earlier on that asset allocators, generally, their obligation is to minimize your policy risk and oversee the minimization of execution risk by the manager and or investment consultant. So in uncertain times, we do find it's a situation where we run over each other, basically, and dictate to the manager in terms of what to do. So my reflection on this, and basically anecdotally as well, when looking at what happened in 2020 at the end of March, where you had a severe capitulation in the markets, and many decided to exit the market, crystallizing losses, and therefore didn't participate in the recovery. My thoughts is that it's better placed for the manager to manage the execution risk, and us as allocators to let them do that. As well, linked to that, I think there's a typo there, is that our participation in the investment process does limit our recourse in the event of dire events that happen. So some solutions to this in consideration of time. So one can adopt more flexible approval processes in the governance structures. So COVID has taught us that we don't only need to meet in person, and you can do frequent video calls. So that's a feature that we can encourage on continuing on with. Then second to that is, in order to shorten the loop between your investment committee and ultimately the board of trustees in terms of approval, is the possibility of maybe having your IC and your board meeting at the same time to basically shorten the loop and ensure that execution can happen quite quicker. The second solution that can be considered is hedging strategies. So first, you can have what are termed explicit hedging strategies, which refer to LDI portfolios, in the sense of basically bond portfolios which aim to match your liability profile over time, and considering derivatives to basically limit downside to your portfolio. Then you can consider implicit strategies which refer to maybe allocating more towards equity, in particular with regard to inflation risk, and maybe private markets to that effect. There is an increasing consideration of infrastructure within South Africa to that effect. Another solution is a pre-approved strategy. So one could generate a range of scenarios, and a set of strategies are approved upfront. And when significant market events happen, it's basically executing those particular strategies. Then lastly, is basically a consideration to maybe delegate more to managers. So therein you have a discretionary mandate, which then allows your manager to basically handle the extreme event and act with a fiduciary responsibility. So obviously, some of these solutions can be considered in tandem, wherein maybe in terms of this discretionary part, it's done with a threshold of an amount in terms of the size of the decisions that can be made in terms of asset value. And also, there's a continuum there which depend on, I would say, trust and the risk appetite that a particular pension fund may have. So there, ladies and gentlemen, are my thoughts on navigating uncertain times, in particular with regard to investment risk governance. And with that, I thank you.
Thanks so much for your excellent presentation, CP. So you were on time. Thank you for that. Now let us continue the discussion with our second panel speaker, Gabrielle, who will walk us through risk management and portfolio management tools in times of persistently high inflation era. Gabrielle?
Thank you, Philip. Hi, everyone. It's a great pleasure to be here again. I had the opportunity to be part of this event over the years, and I have watched it grow to what it is today, and it brings me, obviously, great pleasure to be associated with it, even in a small part. Next, I have a disclaimer. In my culture, time is only a loosely useful planning tool. So I will choose to treat it as such and place the burden on Philip to do whatever he needs to do in this world. No, but I will try to hopefully say something interesting and spur some discussion and questions along the way. So I thought the previous panel made the job easier for us because they have laid out very nicely the uncertainty or what is the basis of this uncertainty that we are talking about. So I'm not gonna talk about any of that. In essence, our role as investment managers, as strategists for long-term institutional investors, is to take that economic environment and think about what it means for financial markets over investment horizons that are relevant for us, which might be longer than just the next 6 months or next year. It is believed that, bear with me, William Shakespeare said, expectations are the root of all heartache, okay? Obviously, he was talking about the field of love and life that I don't know anything about. But I saw this morning, and I thought this is good for my talk here, because I think it applies very nicely to the field of finance that I know a little bit about. So the challenge in taking the economic environment and trying to think about what it means for financial markets is primarily the fact that financial markets run on expectations. They anticipate what is likely to happen and they discount that. And then changes in financial markets occur because reality meets or does not meet those expectations, right? So obviously, just doing what the previous panel was trying to do, so say something about the economic environment, is already a treacherous endeavor, but now trying to take that and say something about financial markets is a little bit of foolish game, but here we are. Uncertainty is obviously well documented. What I will try to say in the next few slides, I'll try to say two things with respect to that. One, that there is a certain type of uncertainty that is more problematic than others. And second, that there are signs of a potential more structural shift in the way financial markets or in the way financial assets interact, and what does that mean for institutional investors. I'm not going to talk about inflation is through the roof, we should all panic. I will talk about this. So, and I will walk you through the slides. Some of the things that I will say are probably a little bit more technical, but I will try to make it pretty clear. So one of the things that people want to think about is, okay, Fed is tightening, is raising interest rates, inflation is high. Are we going to have a recession, yes or no? You tell me that. So it's hard to say. So what we are trying to show here is, let's look at what has happened before over the last, let's say, 50, 60 years, when the Fed has embarked on a tightening process, and see where was inflation in that tightening process, and whether that resulted in a recession or not. So here, the x-axis shows the number of months that since the start of a tightening process, and then the y-axis shows where was inflation when they started and how it evolved throughout. And then you will see that the green lines, 71, 83, 84, 93, 95, and so on, shows tightening processes or tightening events that have not resulted in a recession. This idea of a soft landing. What is challenging and a little bit striking is that in all those instances, the starting level of inflation was not very high, okay? We are now starting from a level of inflation that is higher compared to that. And in previous instances, when you have started, when the tightening process starting from such high levels of inflation, it typically resulted in a recession. So then if you're trying to say, is it more likely than not, probably the answer is that it is a little bit more likely that you will have a recession. But it's obviously anyone's guess. The other thing that I would say is, and this has been also well documented in the previous panels, tightening processes in the US tend to be unkind for emerging markets for the reasons that we have discussed. The idea being that there is a flight to safety, and then that it's sort of harder to finance the debt, to service the debt, and so on. However, I would like to make a link here to the previous panel as well, and turn it a little bit around and think about it from the perspective of a pension fund in an emerging market. when you flip that perspective and you think about what does it mean for a pension fund in South Africa when the Fed embarks on a tightening process, it means that the value of foreign diversification is very high for a South African pension fund. Why? Because you get two things. You probably get currency appreciation on your foreign assets, and you also potentially get a better outcome on the underlying assets themselves. Okay, as we have seen in the previous panel, the S&P is down minus 14, 15%, but the EM index is down minus 20, right? Because of that flight to safety. So I think there is a silver lining in this that pension funds should think about. So that illustrates a little bit the frame of mind that one needs to have when you overlay on top of the economic environment. What does it mean for me in terms of how financial assets are going to perform going forward, and what does it mean for me in terms of designing the strategy for the pension fund? So that was point number one. Here, I want to say a thing here. We have gone through a long period of financial assets appreciating in value, particularly in the developed world, as a result of the recovery from the global financial crisis and a result of the policy stimulus that was put in place, yeah? And when you look at that chart, and you look at the green line, yeah, it has gone up at some point 4.5 times since the financial crisis, since before the financial crisis, so including the global financial crisis. The S&P 500 is now 4 times higher. And if you look at that and you look at the last part, let me see if this works. Okay, if you look at this part and you say, okay, there has been a correction this year, it doesn't look like it has reset things to a fair value or to a long-term fair value concept. Things still look, largely speaking, a little bit out of whack with history, right? So that's something to keep in mind. Now, the other thing that gets me to, so the point here being that there's been some correction, but there could be more to come, okay? The other thing that gets me to my other concern is this one, the other chart. Here, what we show is usually when you try to say something about the future, the value that you have to pay for financial assets today, if you put it in a historical context, should tell you something about what you should expect going forward. So the simple way to think about the value that you are paying for equities today is to look at the ratio between the price and the earnings. How many times you pay for the earnings, for a unit of earnings of that company, okay? Usually, that's the x-axis here. So usually, if you start from a place where you pay a low value for that unit of earnings, then you're going to have a high return going forward. Why? Because you bought the asset low. If you start from a situation where you pay a high value, a high multiple for that unit of earnings, you're going to have most likely a miserable outcome over 10 years, which are horizons that are relevant for pension funds. So this looks at real returns over 10 years based on where you bought the asset, how much you paid for a unit of earnings. So right now, we are about here, P ratio of about 30 on this metric. So you say, okay, maybe it's like 3-4% in real terms over the next 10 years. And you say, okay, I'll get 3 and 4% real return on the equity market. It's not ideal, but it's something. However, the thing that is worrisome is this. This relationship broke in the 70s, where you had a decade long of high inflation, okay? In that world, the value, this metric did not really the relationship broke structurally, because here you start with the low value per unit of earning, but you get very negative real returns 10 years down the road. Why? Because inflation is eating away essentially the earning capacity, and it results in negative real earnings for companies, which then translate in poor outcomes. So that should be the key concern for pension funds when it comes to how do we assess the risk in the current environment. The risk is not really that we're going to have a recession next year. There's been recessions in the past, and as long as inflation is brought under control and you have, let's say, a repricing of financial assets back to fair value, everything should be fine. Why? Because your investment horizon is very long. You will be here 15 years from now. You will be there 20 years from now. The risk is that you will end up in what is called a stagflationary environment, okay? One where inflation proves to be much more persistent than people imagine at this point, and at some point, policymakers blink. They do not have the sort of the stamina or the determination to maintain this hiking process of interest rates, because it's very painful for the real economy. So I think this would be, I don't know if Sonia is here, but when Sonia introduced the 3-door thing, all I could think about was I have this side door to my garage at home. Nobody thinks about that door in my house, okay? Nobody thinks about it, but it's another way to get into the house, you know? And that would be the door number 4, and that would be this, okay? I don't know what the probability is. Maybe it's 10%, maybe it's lower, but this side door is actually the more problematic for pension funds from a long-term sustainability point of view. The other thing, very quickly, before Philip starts running me off the stage, the other thing that is a little bit important to keep an eye on is the investment strategy of pension funds. Going back 30, 40 years, when you talk about how do pension funds invest, everybody's thinking about 60-40 stocks, bonds. That's the golden rule, right? That idea is preached on this assumption that there is a natural diversification between stocks and bonds, okay? When you have periods where the stock market goes down, that is usually because the economy is not doing so great, so the Fed or the central bank is easing policy, and that helps bonds, okay? But in a world of high inflation, that relationship breaks down, and that's a little bit problematic, and you see signs of that happening here. Okay, when you look at this in the US, the stocks and bonds correlation, very low for a decade plus, almost 2 decades, but now it's starting to go up, yeah? And if you go back to the periods where we had high inflation in the past, it was very positive as well. So this is the structural change that I'm talking about, a world where the core tenet of the way we build portfolios for the pension fund is not holding anymore. Yeah? And then the challenge becomes, what do you do then? And related to that, you also see a high spike in cross-asset correlation, not just stocks and bonds, but all risk assets. Yeah? You see that the correlation across all risk assets is now very high. Why is that the case? Is because you have pretty much a global environment of high inflation and raising interest rates, right? So there isn't any natural geographic diversification if you exclude China. Okay, so what do you do about it? I think the most important thing, trustees need to have a very good understanding of what risk actually means. Yeah, what that risk tolerance that we are talking about, what does it actually mean? When you come to a year like 2022, and your returns for the year halfway in are minus 10, minus 12, minus 13%, as a trustee, you need to have a clear understanding whether that is within or outside your risk tolerance. Yeah? If it is within your risk tolerance, which I argue so far it should be, then I think you have to have the ability to look beyond that, okay? Look beyond that and say, I have a long investment horizon. How should I assess things in that time frame? Not necessarily panic because we have poor outcomes over a 6-month period. So I think understanding what the true risk tolerance is and sticking to it, it's probably the most important thing, because that allows you to not make decisions that feel good in the moment, but are actually counterproductive in the long term. Just to go back one second, just a quick anecdote. Time is up. Just a quick anecdote here. In 2015, 2016, after the stock market has gone up about 200% since before the crisis, some of the members in our board of trustees, they were asking us to take some money off the table. In other words, reduce the level of risk because they felt that we had such good outcomes and it won't repeat itself. Well, it goes to show that it's very hard to predict what's going to happen, because over the next 6 years, that has doubled again. So it's it's fundamentally important to understand what your risk tolerance is and stick to it, yeah? Then the other thing that is important is this. As I have highlighted, now is the time to look into door number 4, okay? Now is the time to say what could be very, very problematic for us over the longer term. And what could be very, very problematic, I posit, is a period of very high inflation with mediocre growth, a stagflationary environment. Let's do a little bit of work and understand how our asset allocation is going to perform in those types of environments. What kind of assets are going to appreciate? What could give us diversification? What could give us some protection? And let's make sure we have a very clear understanding of that, because as things happen, then we have a better chance of responding or reacting appropriately. Then the other thing that I would say, and then I'm going to stop, Philip, is don't forget about liquidity. Yeah? Don't forget about liquidity. It is important to think about what happens if the world kind of stops for a little bit. What happens if I cannot really access my liquidity easily? How do I make sure that I have enough contingencies in place, and how do I make sure that I have an asset allocation that has sufficient, very liquid assets that can help me meet the cash outflows that are there, whether it's commitment to unlisted funds, whether it's payment of benefits, whatever it is, in a manner that does not induce forced selling, in a manner where I don't have to go to my, let's say, credit managers in fixed income and say, now you guys have to liquidate half of your portfolio, and they tell you, well, nobody wants to buy these high yield bonds at the moment, so we're going to give up 60% of the value, right? So I think doing that, having a plan and kind of a strict idea in place, how we're going to deal with that is important, yeah? And then the other things I think we can address in the Q&A. Thank you so much.
Thanks so much for very insightful presentation, Gabriel. Now, let us make a pause with a couple of questions. First one is to Sifiso. You mentioned that a timely decision for significant event as one of the challenges and suggested several possible solutions. Can you tell us about factors to consider when appropriate delegation is made? For example, do those include technical expertise of investment committee members, investment committees, or is it empowerment, or is it oversight and control mechanism?
I'll say, yeah, all of the above, to be short. So I'd say it's a factor of that, I'd say skill. You have in a manager the ability to read the markets and basically watch what is happening, as opposed to, I would say, from the asset allocator side, we do engage with the markets, but not as continuously. So an appropriate factor to consider in terms of delegation is that. The other component as well is with regard to your actual, I'll say, governance process as well. So we are in charge of the strategic asset allocation, but we delegate the tactical calls to the managers themselves. And ours is to ensure that whatever calls are made are within the tactical bounds that we agreed to. So keeping into mind that, yes, there's skill involved and a governance structure, and also having an element of trust as well, to ensure that basically assumes that the manager will be executing or transacting to our benefit, I think makes for a good governance process.
Thanks so much, Sifiso. And the other question is for Gabriel. I actually have two questions. First, to fight for high inflation around the globe, do you think a recession is inevitable? Is it a necessary condition? Or the fourth door could come at some time?
Look, in my view, I think we need to be humble about our ability to understand and forecast these dynamics accurately. I don't know. I think based on the dynamics that one can look at least in the US with respect to the labor market and so on, and in Europe, I would say probably there is a higher chance that there will be a recession. I would say just intuitively, one would think that the Fed would have to bring rates to a level such that the real Fed fund rate is close to positive. Right now, we are not close to that. And furthermore, expectations, again, the expectations are that the Fed is going to go to maybe 4%. That would still not get you there. So the worry would be, they may probably have to go a little bit further, and then it becomes almost inevitable. But we don't know. Maybe there are indeed some transitory factors, and maybe there are some supply disruption factors that will ease and will bring inflation down. But right now, it's looking a little bit unlikely.
Thank you, Gabriel.
Sure.
The second question too is on your last slide, you suggested as a portfolio management tool an overweight of areas that offer sustainable long-term cash flows in real terms that might be less sensitive to interest rate increases. This is quite appealing. So can you please take a couple of examples for the areas that you have in mind?
So again, I'm thinking about this fourth door where you have a prolonged period of higher than expected inflation. Over 6 months or 1 year, it doesn't really matter because assets will sell off regardless whether you hold real estate or infrastructure or whatever. Assets will sell off in response to higher interest rates and so on. But over a 4, 5, 6, 10-year period, if you go into that more entrenched environment, it's going to matter whether you have cash flows in your portfolio that have inflation adjusting mechanism built into them. Yeah, and intuitively people would think about real estate. We'll think about hard real assets, right, that have income attached to it, like real estate, infrastructure, and so on. And then you can expand that to also think about where the world is going. And again, when you think about that, there is an increasing need for things like digital infrastructure, telecommunication, data, server processing capability, and things like that. So that type of infrastructure, I think it also has a structural demand growth embedded into it. So things like that could potentially help.
Okay, thank you for your insights on that. Now, let us continue our discussion with a third speaker, Shafiq Abrams. Shafiq will share with us the EPPF's perspectives on asset liability management, tactical asset allocation, and diversification in navigating uncertain times. Shafiq, please.
Thank you, Philip. Good afternoon, delegates. Thank you for the opportunity to share some thoughts on asset liability management and the EPP's view on strategic asset allocation in an uncertain environment. Now, when one confronts the discussion of navigating an uncertain environment and markets and assets and correlation, one is inclined to share the sentiment of investor Peter Lynch when he says, people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game, and he goes on to state that you get recessions, you have stock market declines, and if you don't understand that's not going to happen, then we may be not ready for it. A second approach might be to say, let's take a long-term view, let's manage liquidity, let's ride it out. Things will smooth itself out. However, I do think the issues are much more deeper and strategic than those sentiments. And so the questions we have to address is how do we get grips over the nature, complexity, and pace of the change with a view to getting up the curve and navigating this uncertainty. And to use the words of Justin Trudeau, the pace of change has never been this fast, yet it will never be this slow again. And so, colleagues, some of the key challenges that we experience coming out of in this time is that recent uncertain times have indeed brought the old mean variance and optimization frameworks into question as the context changes and the times change. At the same time, it's not easy to find skill and experience around that you can refer to. And even then, it's debatable whether you can compare to periods like the past, like the 80s, right? This therefore then creates an opportunity and a need to explore different approaches to formulating asset allocation strategies. Now, I think it's always important to note that in ALM, we got to contextualize the uncertainty and downside in relation to the liability that we're managing. And I think earlier speakers have alluded to that too. Typically, a matching asset needs to move in unison with the liability and as close as possible to the match. And so the first point I would like to make is that in ALM setting, the focus becomes much more on minimizing the mismatch risk rather than the absolute volatilities or market risk. So as a result, scenario modeling as a tool, which is widely used in strategic analysis, becomes even more important tool, and I think Gabriel has alluded to that as well, in allocating assets in uncertain times. Now, in this way, we can go beyond just extrapolating learnings and historical patterns of asset classes to test proposed allocations under different scenarios. And I think the suggestion of testing asset allocations under high inflation environment most probably more prevalent right now. So as a result, correlations of asset classes based on historical data has attracted some criticism in that the long-term history and trends may not be a good predictor of future scenarios. And therefore, scenario-based distributions as input into the asset allocation models are becoming much more popular as a practice in the discussion and in the approach. However, it's important still to recognize that one can still learn a lot from history, and that while you anchor your forecast and your correlations in history, you've got to blend it with tools such as scenario modeling to take into account extreme conditions such as recession, stagflation, and scenarios that may be more appropriate into the future. Now, a second and much bigger focus that I think we're all trying to grapple with is to focus on downside risk and extreme event risk. Our ability to understand where the tail events are going to come from and what that impact is going to be on the asset class, rather than the distributions of the bulk of the time events, becomes more relevant and more critical. And I think as we go along, we need to start to spend a little bit more time modeling those potential extreme events and what it means to the portfolios and how do we respond to that. Thirdly, I think as a tool, flexible allocation policies that allows weights to shift with extreme conditions becomes even more important, right? Now, in periods of higher risk, we will tend to shift assets to safer assets and vice versa. And so the concept or the thinking has become more about moving to a stable risk profile rather than a rigid weighting scheme that is designed to maintain a stable risk profile rather than a return profile as was in the past. Fourthly, and in uncertain times, I think tactical asset allocation becomes critical as an additional tool. Now, this allows for a risk and return lever to become much more important to use. In a maximizing or CPI-related liability world, such as EPPF, tactical management becomes sophisticated, more opportunistic, with clear rules and triggers that govern it and dictate how we make those decisions. Fifthly, diversification becomes even more important as the best go-to strategies. And we need to start looking for alternative sources of growth. I think earlier speakers have also alluded to the need for infrastructure and private equity opportunities as an example, even though it does bring its own risks, which we need to understand and factor it into our allocation models. However, uncertainty more than ever requires us to understand the risk premium more clearly within these asset classes, with a view to understanding its predictability, its stability, and ultimately as a frequent participant in the allocation models, such as equity and bonds. So hopefully, as this place of work evolves, we hope to get better data around the risk premium within these asset classes that will assist us going forward. Now, colleagues, I think we all accept that in this space and in this time, managing assets has now become more difficult to manage, given this unstable and also dynamic environment. We think there's a need for a much more disciplined approach to this, and one that's informed by newer technologies. We do believe that data science applications have come a long way, but we need more innovation, more analysis, and more technology-driven solutions to help us evolve in this space. And therefore, current and future innovations will continue to make progress and have made substantial progress in this space. Ultimately, this will get us up the curve in managing the recovery times, as well as the allocations uncertainty as well, and in the decision making. So as the graph indicates, as we navigate this uncertainty, I think we can be certain that human innovation will continue to trump fear, and that new models will continue to inform our decision making and give us the confidence and comfort that we need to move forward with. Thank you.
Thanks so much for the excellent presentation, Shafiq. Now, let me invite the next speaker, Ono Steenbeek, who's going to talk about pension challenges, communication, and pension reforms. Ono?
It's quite a long list to put in 10 or 15 minutes, but I'll do my best. In the Netherlands, we like to stick to time in general, but my wife is from Italy, so I warn you. She has a big influence on me. Let's give a start. It's a great pleasure to be here with so many experts from close and far away. It's always and being in person, it's a great pleasure. And then at this wonderful location, Cape Town, one of the most exciting places in the world. So thank you for having me. Well, the first slide we can do quickly, because I think everybody has explained that it's quite dark outside, and this confirms it once again. Maybe one I would like to pick out, well, climate change is one. So it's not only the investments we need, it's an existential threat to many countries like the Netherlands. We are, even without any further change, we are half below sea level. So that's a challenge, and there are many experts that say, well, we have to adapt to climate that has changed, which requires additional investments. Demographics is another one. In Europe and parts of Asia, aging trend is felt all around. I think in Japan, the population is losing 600,000-700,000 people a year now. So moving from 125 million all the way to 100 million in the coming 20 years. That's a development that is difficult to deal with, right, in terms of pensions. In certain countries, it's the other way. There's this demographic dividend that you can exploit. And African countries, some, not all, but many African countries still have that dividend, that the productive population is much larger than those who are dependent on others. Financial markets, I'll skip. Some government influence, one or the other, all mentioned, and let's just go to the next one. Basically, it's dark out there, and it brings pressure to pension contracts, and this is a major challenge. We look at the pension funds that I work for in the Netherlands. We look at this triangle, basically, trying to find the balance between, on the one hand, the ambition, or the promise, as you will, and on the other hand, the cost, so the contributions that people have to pay, and the certainty that comes along with that. So we have moved away from certainty a little bit in order to keep the cost under control, while keeping the ambition the same, right? So what you see now is that there is upward pressure on contribution rates. There is the rising probability of pension cuts, so people actually receiving less pension benefit next year than they did last year. And a fully indexed pension, which was the ambition, has not been realized for quite some time now in the Netherlands. It's also got to do with the way we value our liabilities. We use the risk-free swap curve, which is now at a very generous 2%, but it used to be almost zero for a while. So if you use that tool, then it's a challenge to keep your funding ratio where you would like it to be. Okay, so what do we do? Well, Shafiq already discussed this, so I can also go quickly. Economists in general, and I'm one, have difficulty predicting, especially if it is the future that you're talking about, right? So explaining what happened in the past is pretty well in good hands with the economists. If you look at the future, it's challenging. So you need scenarios. So we use stochastics, and we use a stochastic model, very complex, very difficult to explain to board members, even to myself. And the inflation spike that we just had was outside of this cloud, right? So basically we said, well, we need something, an additional tool. So we developed another tool where we said, what if inflation stays high? We don't expect that to stay high, but suppose we are wrong, like we have been in the past quite some time. So those are two tools, basically two sets of stochastics that help us. This basically a cloud of spaghetti that you can use to try to say something about probabilities going forward. In addition to that, we said, well, this is something which remains abstract. You can talk about probabilities, you can adjust your portfolio a little bit, and the probability that you fall below a certain level drops from 5% to 4%. So what does that tell you really? So we added to this list a set of deterministic scenarios. So basically storylines. So what if this happens? And I will go very quickly through them. We were helped by Cardano. Maybe you know that company. It's also a Dutch company. And basically, it's a way to, as they say, memorize the future. So think through certain scenarios. So when it actually happens, you're not that surprised, right? And you know what to do, ideally. So we have 4 of them: stagnation and debt, demand shortages. Policymakers are not able to to do something about it. They might actually make it worse. And you have a scenario, LDT stands for long duration treasuries, and transition of about 5 years, and then a long-term equilibrium, or equilibrium for the next 10 years or so, which is very gloomy in itself. The next one, climate trench. Basically, it says negative supply shocks, positive demand shocks, deglobalization, the climate, obviously, and government action. So it would also be bad news for treasuries, at least in the short term, and inflation would stay higher in that scenario. Equity will take a hit for the coming 5 years, 8% per year, right? So that's quite a sizable shock. The third one is good globalization, because we had difficulty finding a positive scenario, but the board members insisted that we at least have one. So good globalization, basically everything comes together and will go well. So inclusive globalization, inequality is going down. So we get into a virtuous circle of investments, stability, growth, which leads to eventually higher interest rates. So in the transition, you will get a hit for the treasuries, but eventually it's okay. And the final one is specific for Europe, where the EU is unable to keep the monetary union together. So that's another challenge, and we don't know what happens after this transition phase. It would be very gloomy indeed. Okay, so what do we do with this? Look at how asset classes behave in those areas. So we have had, basically all asset classes went up over the past 10 years. Had this tailwind of falling interest rates. Everything did well. It was difficult to make a mistake if you prepared your strategic asset allocation. But still there are differences, obviously. So this is Bridgewater, you probably know, this all-weather portfolio. They use this type of tools saying that there are different shocks. And we're not interested in the shocks. In the individual asset classes, we're only interested in the total. But it's difficult in time and age that we have now, that we live in now, to find asset classes that help you. But this is at least something. Commodities obviously did extremely well. So then you have limited tools to actually navigate the pension fund. And I will take a slightly different angle here. The first is honest communication with plan members. So times are challenging outside, and everybody realizes that. And it's not strange if you tell people that it's actually challenging, and that might have an effect on pensions. And the other one is maybe adjust the ambition a little bit. And this is something we're trying to do in the Netherlands currently. After 15 years of talking, we finally, and this week it's in Parliament, a new pension law, trying to change the ambition, change the pension contract. So this is one, first on communication, one way what we did is actually show individual plan members how much we reserved for them in their pension pot. And it got very positive response from plan members. They said, okay, I thought it was empty, but it's not that bad after all. And also the distinction between what you pay, what your employer pays, and what the assets have been doing over the past 10 or during your active life. So basically, returns are about 3/4 of the total pension income you're likely to receive at the end of your career. And the second one, it is also by law we have to communicate risk, which is always a challenge for individuals. So we have to obviously tell individuals what their expected benefit is, but also when it does not go that well or when it goes better than expected, and what that implies for the outcome. So communication of risk, in general, it's a separate field. So what we saw in the Netherlands is that it's very difficult to maintain the current DB contract as it is. And basically we have been on a road to shift more and more risks to the individuals over the past 20 years or so, from a final pay DB but we hope not to end up in an individual DC system eventually. But this is very difficult to change the pension contract, extremely difficult. And I did a study last year, I'm happy to share with you, where the Dutch Minister for Pensions asked me to look around the world and see what type of lessons we can learn from other countries that went through a reform process. And, well, very difficult indeed. And I would like to stop to finalize my story with a couple of observations that we had based on that. So why is it so difficult to change something fundamental to the pension promise? Well, the first one is that the long-term trends are now so challenging. So we have talked about it. Demographics, at least in Europe, lowers economic growth, all the challenges that are at the same time simultaneously occurring, which basically means pension has become more expensive. Whatever the contract is, you have to pay more and you get less. That's basically the bottom line. And partly that's the fault of the individuals themselves because they live longer, but obviously it has to be paid for, right? The second reason why it's so difficult is that pension systems have become so complex. I don't know about South Africa, but I imagine that it's similar to the Netherlands, where you have 3 contracts in 3 markets. It's the political market, it's the labor market, and it's financial markets. They all have their own dynamics, and it's very difficult to find a new optimum in that type of arena, that type of system. And if I look at the Netherlands, everybody has an opinion. It's almost like the national soccer team. If you talk about pensions, everybody has an opinion about what should change and what should get better, and they make a mess of it, etc. So it's very difficult to get everybody on board. That's why it took so long. And finally, after 15 years, we have made a change, and it's still not certain that it actually will survive. Then the second question is, well, if it's so difficult to reform, why would you start in the first place? Now, the reason to start in the first place is that there is a crisis. And in the Netherlands, there has been a pension crisis for quite some time. So this discussion, people having the feeling that they were not treated well or promises were not met, that has been a major reason why we talk about reform. But we needed a global financial crisis in 2008 and 2009 to adjust the retirement age. So never waste a financial crisis. And look at the current situation where everything comes together to see, well, what can we change? This might give us the momentum to make the whole system more sustainable going forward, right? Then the third question, well, if there is a crisis, is that sufficient to actually get your reform done? Well, not really, because you have to have the possibility to act. In certain countries, it's very difficult to change the contract, especially if you look at the past. If you look at the US public funds, they are locked in contracts. It's very difficult to say, well, you expected this from your pension fund, but it will be 10% or 20% lower than that. That's impossible. It's a contract between the employer and the employee. You can go to court as an employee and you will probably win. So as a result, you have to play around with the discount rate a little bit in these public funds. They are now at 7%, suggesting that they will realize 7% for the rest of eternity, which is a challenge. And still the funding ratio is significantly below 100%. So that is, in the Netherlands, we would call that a pay-as-you-go system with a little reserve account linked to it. But anyway, that's a challenge. So having the possibility to act, that's one. There must be agreement with all these stakeholders that the proposed course of action is the right one. That's a challenge. And then there should be an opportunity to actually implement the changes, the proposals, which is also a challenge. And then finally, when is pension reform a success? Well, if the reform solves the problem, right? So you have to agree on the problem that is to be solved. If it can be implemented, and if it's accepted by a sufficient number of people, and also that it should not prevent future adaptations. So what we see in many countries around the world, there have been pension reforms, And it was implemented thinking that it was the end of history, but then subsequently new challenges, new ideas came up. And the pension system should allow for that type of changes. So let me stop here. Thank you very much. And I will just, this is what I basically said. So
Thank you so much for sharing with us insightful thoughts on challenging but very important topics. So let me ask a question to Shafiq and Ono, and then let's move on, whether we can find enough time for our audience. So Shafiq, there's a lot of hype in terms of tactical asset allocation, which is presumed to add positive alpha. But in many cases, tactical asset allocation can create a negative alpha, and many institutions do not heavily rely on tactical asset allocation that needs a strong conviction to a market movement. So what do you think are caveats for successful implementation for tactical asset allocation? So is it capacity to beat the benchmark consistently, or robust governance framework for tactical asset allocation?
No, thanks, Philip. I think, Alana spoke about it earlier on. As you manage in the volatility, you could be allocating assets in a way that creates more and more risk. And so I think the starting point is the risk that you're managing and the overall risk profile that you're managing that should inform the decision. And I think the risk budget framework and the risk appetite that you're dealing with under the circumstances should govern that decision or direct the decision. That's the first thing. The second thing is there must be a robust governance in place, because everyone will be allocating every day on a tactical basis. So we need to understand what are the trigger points, what are the decision-making points, and how do we do it, yeah? So that must be clearly defined upfront most probably in a pre-document of sorts. Thirdly, I think execution becomes critical. The ability to execute with speed, accuracy, and in a way that can generate alpha, or even in certain times when you're managing risk, to look at the opportunities for return and see how you can manage it, requires skill, requires talent, it requires a network of partners that you can rely on, and access to data and conviction as well. And I think all of that defines how you would move it as well. Yeah.
Thank you for the excellent feedback, Shafiq. Ono, you mentioned the importance of honest communication with pension plan members, which I also completely agree with. But in reality, it would be quite challenging if you need to convey a message of a decline in pension promises. And there are also many country or institutional specific factors to consider. So what do you think is the most effective tool that pension fund managers could deploy these days in terms of communication?
Yeah, I agree, it's very difficult. And we are gradually moving from a situation where we did not communicate at all with plan members. And plan members, it was a pretty boring sector where we worked in, because you would just meet your expectations and that's it. And people younger than 55 were not thinking about their pensions anyway, they still don't. So to get the message across is difficult. So you need all the tools in the world to do that. So in the public media or but most effectively, direct communication to the individual participant, hoping or expecting that you eventually reach the person, the people that you want to reach. So it's a difficult. In practice, if you ask people in the street, 10% of people know that something is going on with pensions in the Netherlands. And 19% has no idea whatsoever. So that gives you a challenge. And if people want to use the communication to change something about their savings and expenses behavior, then it's usually too late to do something significant. So this is an international challenge, I would say. Yeah, and the most effective way would be, let's say, direct communication to the individual. And I think the current technological tools are more and more able to help us with that.
Sure, indeed. Let's see, I think we have about 30 minutes to go. So before we open the floor for the audience, let me switch gear to ask just one question, one common question for all panel speakers. And so this is about responding to climate changes. So there are more pressure than ever on public pension funds in terms of their roles in sustainable investment, which we will be deep diving into the later section. But do you think that the focus on sustainable investment could be a critical part of the asset allocation? Do we have like critical mass in terms of putting your portfolio into the fields of sustainable investment? So for that, maybe we'll start with Sifiso. And yeah.
Okay, thanks for that question, Philip. So the role of sustainability within pension funds investment strategies is very contextual and depends largely on the jurisdiction in which pension funds are in. So within different jurisdictions, ESG has different points of emphasis. And I would say probably in South Africa, we have more emphasis on the social side of things. So in particular, within the GEPF, we focus more on the just transition approach in terms of sustainability in our investment strategy. So what that says is that we consider the historical dependence of our economy on non-renewable industries in terms of what they contribute in our economy and just from a social point of view in terms of employment. But also equally, we then consider the shifting trends in terms of investment into more renewable industries, especially in light of climate change. So effectively what that means is that from our strategy, we will and continue investing in non-renewable industries just because of that linkage and dependency on the economy, but also equally engaging the entities in terms of more sustainability, in terms of being more sustainable in producing energy. So that's the first aspect, because we don't apply an exclusionary approach in terms of our sustainability strategy. Then another angle to that is that in as much as we continue investing in non-renewables, we'll then ramp up investing into the renewable sector to increase the capacity in this industry. And I would say probably the past year, and an emerging trend that's emerging is within infrastructure. There lies in an opportunity to do that. So yeah, that's my reflections on that question. Thanks.
Thank you, Sifiso. Gabriel?
Is it come? Yeah. Hopefully, all the investments that we put in our portfolios are sustainable from a longer term perspective, because that's the very nature of our business. I think there is, if I were to break it down into how it would make sense, or what's the challenge would be to say, are you purposefully changing your asset allocation or adapting your asset allocation to have specific allocations to assets that are supposed to further some ESG goals, whether it's climate adaptation, whether it's social or whatever it is. And I would say it's very difficult at the moment to have frameworks that are capable of doing that. Yeah. There is a lot of analysis that people undertake in trying to understand what may be the long-term impact of climate change on various types of assets, but there isn't a clear framework to say these are the things you should be investing in as a long-term strategy and these are the things you should not, other than a priori exclusions, okay? So I would say that's where the focus is in understanding more how to build those frameworks. And then from a practical point of view, in terms of what you do on a daily basis, you continue to rely on the, if you want, on the invisible hand in the sense of a bottoms-up process. We have investment professionals that look for the best opportunities in every different asset class. As a result of that, or as a result of the world changing, the attractiveness of different opportunities that are more aligned with ESG objectives increases. And we will allocate to that, and we continue to allocate to that. So renewables, infrastructure that has certain types of characteristics like that will, private companies through private equity and so on that further certain angles of ESG will be present in our portfolio, but without that being a stated goal up front. You're not going into it with the idea, I'm going to buy or I'm going to invest in a particular asset because I want to develop this particular neighborhood or this particular part of the city, or because it has some great objectives in terms of increasing diversity and so on. No, you go in it because it makes sense from a financial perspective, and it may have attractive features on that basis as well.
Thanks, Gabriel. Shafiq, please.
In terms of sustainable investing, I think it covers our portfolio and different ways that we do it. So we've got a dedicated development impact portfolio, which drives social investment, renewable energy, etc. We've got the infrastructure mandates that helps us achieve that. But we do subscribe to the philosophy similar to the GEPF that the S is critical, and the commitment to the just transition is a key focus for us in South Africa, and as well as other emerging markets. But at the same time, through our ESG efforts, which inform our approaches to the listed side, we do believe that we'll apply an engagement approach with our partners. We believe divestment exclusion doesn't change much, so we need to go through the process of engagement. As we speak, we are in the process of finalizing a climate change policy, but I do think it's not an easy thing. There are many implications in terms of the benchmarks that you will use for the mandates, your policy of engagement, the reasonability and achievement of those targets. But in principle, we need to commit ourselves to that. It's a question of how we find the journey going forward. Yeah.
Now, I think it's time for our panel members open the floor, and happy to have any questions that you may want to ask. Please. Right there.
Hi, so I am Mahlatse from the presidency. I am advocating for infrastructure investment. One of the things that would have happened over the past 2 or 3 years is that the presidency has really been driving the underscore of infrastructure being, the thing that would really stimulate economic growth. So what we found is that the capital to invest in infrastructure is there. The appetite from the pension funds, as indicated today, it's there. But the pipeline to invest in, that's where things are lacking. So what we found is that in all the projects that we'd look at, whether it's water sector, telecoms, digital, whatever it is, 60% to 70% is not well prepared. So what does that mean? They don't have a business case that will give you that economic viability for your credit committees or investment committees to say this is a good investment that we should go into. So now my thing is, what are we doing to bridge that gap that developmental or assisting that project preparation component. Because once you really build a robust pipeline to invest in, the risk premium and all of those elements, you're starting to really address understanding what it is that you're investing in and also creating a pipeline that is at least credible. So as the people that put the mandates for the asset managers to invest in, should we not also start thinking about the funds that you allocate? Let's say you wanted to go to infrastructure or whatever other nuanced space you want to invest in. Should there not be a developmental component, whatever percentage it is, but something to really start generating the pipeline to actually invest in? Because otherwise we'll never really solve the investment gap that we're trying to meet, and also bringing you in to such as in projects that where you actually believe in is good for your portfolio and the exposure that you have. And I think that's a conversation that's been lacking quite a bit, not only from the pension funds, but I want the pension fund perspective, but development finance institutions and MDBs as well. So everyone's willing to participate when the project is well prepared and it's already down the line and you can see the returns coming in, but no one's willing to take the early stage risk. And specifically, I'm seeing this in infrastructure. Thanks.
Thank you so much for sharing excellent thoughts. And some questions. Would you like to respond, Sipiso or anyone?
I think,
Yeah,
I think we all agree that infrastructure as an asset class is a perfect fit for pension funds. And I think the speaker makes a point that we need bankable projects. We need a stronger pipeline of projects. But with that, and I think we have great examples in the country, the REAP program was a great example. We may have to lift those templates from the renewable energy space and try to replicate it in other parts of the infrastructure work that we need to do. But I do think there's a need to look at the pipeline, and I think the minister spoke about it earlier today as well. And I think, yeah, but I think there's definitely appetite to invest in infrastructure, but we just need to get the right pipeline. Yeah.
Thank you, Shep.
My reflections on that is, I think, largely covered by Shafiq as well in terms of applying the learnings from the REAP program. But also, I think it also depends on, I don't know, because infrastructure means many things to many people. And obviously having the most recently published definition helps to basically define what we're talking about. So I'd say in terms of the pipeline issue as well, it really, as for pension funds, the primary duty is to members and ensuring that the promised benefit will be met, right? So so when framed from that perspective, it's very difficult to then assume the responsibility of ensuring that there's pipeline. I would say that's more the space of policymakers in creating an environment that will enable that process, as the minister outlined earlier on. So in particular to that, then, for example, in our fund, we do have a framework where we invest directly and indirectly. So within the direct investment program, part of it, that's where we'd need that conducive environment in which the investment can happen. And then obviously in the indirect space, you have all fund managers who've been saying the same thing. And if the regulatory environment, as the minister alluded to earlier on, is improved and enhanced, they themselves will be able to construct products which they'll then on-sell and package to funds to invest in. So I would say, yeah, from a pension fund perspective, it's important to reflect on the purpose of the existence of a fund and basically allow the policymakers to create the environment. Then we'll respond accordingly. Thanks.
Thank you, Sipiso. Any other questions or comments? Okay, Ona, yeah, please.
Just to add, I mean, I think infrastructure is the asset class that fits exceptionally well to the purpose and the position of pension funds, right? I mean, there are many asset owners around the globe, but pension funds have this long horizon, are looking for stable returns, and at the same time invest in an economy that eventually will produce additional returns, right? And many asset owners, most asset owners are unable to participate in this asset class. So my view is that it should play a bigger role in portfolios going forward. And there are many, as we saw from all speakers almost, there's a lot of need for investment globally for many reasons. And in public-private partnerships, we can, I think, accomplish quite a lot together. If we work together, that's another thing. So, yeah.
Thank you for the excellent point, Ona. Any other questions or comment? I think you are all eager to go for a lunch break now. All right. Thank you so much for your time and great questions. And I would like to thank my panel speakers for their great job. Thank you.
Thank you, Philip, and to the rest of your panel. Enlightening, very interesting, very important, and we do appreciate it. I'm very happy for you to exit the stage left. Thank you indeed. Let's give them another round of applause, shall we?